Yo, what's up, boys? My name is Zoran Alexander, or some of you guys know me, Zoran Trades. And today I'm going to be talking to you guys about the one secret rule in the market that has secured me personally over 1 million Rand in funding in obviously prop firm accounts. And this is something that I feel when I was learning, if I had been told this a little bit sooner, I would have probably found a little bit more success trading a little bit sooner. And for the significance that it actually has in the market, I do think that it's very much overlooked. So without further ado, let's get into it. The thing that I'm going to be talking to you guys today is relative equal highs and lows plus or combined with a strong draw on liquidity. So first of all, what are our relative equal highs and lows? Relative equal highs and lows are these points in the markets where, for example, you see we have this high here, right? This high right there. This is the highest point within this entire range here. Within this entire range, this is the highest point, right? And let me just, actually, I'm sure it's working. This is the highest point in this entire range, right? This is our high. And as we can see, we come down, probably sweep some sort of liquidity here, and start trading back towards that high. Make a higher high, higher low, higher high, higher low, higher high. But here, this is a liquidity point. It's a draw on liquidity, right? What does that mean? That means that price is likely to draw there. You can think of it like a magnet. If there's a magnet here and you hold metal just below this magnet, right? It's gonna end up just drawing it higher because there's a magnet there. And that's the same way price is going to act, right? So you can see here, if this level here gets edged and we actually don't end up trading into the level, what can we expect price to do? Trade into both of these levels on the next sweep higher, right? So once this happens, okay, we could just buy and hope that it doesn't sweep out the lows. But what do we know price is going to do? Higher high, higher low, higher high, higher low, higher high, higher low. Once we see the low get put in and we see that we are starting to trend back towards this, that is our signal to go long. Obviously, there's a little bit more confirmation that we're going to need, but ultimately speaking, that's our signal to go long, allowing us to target this high right there. Because we know it's very, very, very likely, more often than not, 9 times out of 10, if a strong draw on liquidity gets edged and does not get swept, especially on YM, right? When you're trading NASDAQ, there's something called SMT, which is a smart money transversion, which means we can have two highs right next to each other or the same high because NASDAQ and ES or the S&P 500 are correlated assets, meaning if their chart looks very similar and we have a liquidity point up here, which is going to cause a reversal, if one of them sweeps it, the other one can be treated as though it's also swept that level. But I personally trade YM futures and we don't have a correlated asset like that. So I don't have to worry about that. And when this happens, I know for a fact, if this level gets edged and then we put in a higher low, I know this next move higher is more likely than not going to fill out both of these levels, sweep this liquidity, and then maybe continue higher or maybe reverse lower. But either way, I've already gotten my piece of the pie, right? And this is alone is enough to build an entry model around. And then you can enter based on what you like. I trade inversions, so I wait for the highest time frame inversion in this trading leg, enter there, and then target the highs again. But you can wait for a nice break of structure, you can wait for order block to get filled, anything. The most important thing is that you have a relative equal high, or sometimes it's perfect. Sometimes what happens, it puts in a perfect equal high. It won't sweep it, it will tap it, right? And that is when, like, it literally has to tap it, not sweep it. There's a perfect, you can put on an indicator, it's called Equal Highs by Jay-Z Stir. I don't have it on right now. I'm pretty sure it's by Jay-Z Stir. And that's going to tell you when there's perfect equal highs. And again, acts the exact same way. Very, very, very likely to get reswept. So that's exactly how we can plan our entry model. And I'm just going to show you guys an example of this. And before that, sorry, I wanted to get into one more thing. But you see here, very clean again. Clean, edges this high. What do we want? We want to see a retracement and then trade this leg up. Now, draw on liquidity, right? This is going to work if you are trading into the next obvious level in the market, right? But if you really want to see proper results with this, you need to combine this with a strong draw on liquidity. And what is a strong draw on liquidity? I have a few examples here for you guys. So a few examples of some, oh my God, don't tell. Sorry. A few examples of some strong draws on liquidity would be previous day high and low. So the highest point that the market has reached, let me just make sure my camera is at the highest point that the market has reached within the previous day. So if it's Monday, you check Tuesday's range, you can go onto the daily chart, mark out the daily candle and see what is the highest and lowest point that it's reached. Another very strong draw on liquidity that we have is London high and low. So the London session, always when you're trading, you always want to keep your time in New York time, negative UTC, -5 New York, right? And the London session is going to be the price range between 2 a.m. New York time to 5 a.m. New York time, right? And between that point is when the London session is active, and that is when a lot of liquidity is going to be made in the market that we're going to react off of. So the highest and lowest points in that specific time frame, 2 till 5 a.m. New York time, are going to be key points in the market that price is not only going to draw to, but then end up reversing from. Same thing with the Asia session. The Asia session, exact same thing. Asian stock market open, sorry. And that is going to be from midnight until sorry, not midnight. 8 until midnight. Sorry about that. It's going to be 8 New York time, 20 or 8 p.m. New York time until midnight, right? So those are going to be another strong draw. Asia low, London low, Asia low and high, London low and high, previous day low and high. True day open is another one, right? True day open is going to get formed. It is the level at which the day opens. It's 0000 to 0001, right? And that is true day open, which that level, again, if it's unmitigated, even better, but it gets traded into often. Once we trade through it and then we come back, we still end up tapping it and then coming higher. And it's always very likely, even if it's been mitigated or traded through, that we're likely to retest that level. So that's another really good draw on liquidity. This is a little bit more of a rare one, but previous week high and low, that's slightly more rare for us to be in a range where we're targeting the previous week high or low, because that has to look something like this, right? We're going to be trading like this for the whole time, for like a week, and then for us to be breaking out of such a massive range and then, being down here, and then let's just say this is 2 weeks worth of price action, it's only going to really happen one time every few weeks or something like that, where we're really going to trade into previous week low. So that's not too common, but again, strong draw on liquidity, previous week low. If you see it open, keep that in mind. I didn't write that down now, but same with previous month low. If for some reason the low of the previous month is right what you're trading towards or something, this is going to apply perfectly. That is a beautiful draw on liquidity. And then obvious 15, 30 minute, 1 hour, 4 hour highs and lows, and daily, sorry. So again, with this, it's less about the time frame actually, which is something that I didn't get taught early on. It's less about the time frame and more about how obvious the high is. So, okay, if you have 2 4-hour candles, yeah, it's the highest point within 4 hours. But if we have 2 4-hour candles like this right next to each other, like I can make an example. If we have this and this, right? 2 4-hour candles right next to each other. Okay. And let's just say the previous candle looked something like this. Okay. If this is what our last 3 candles looked like, I'm gonna put some wicks on these bitches. There we go. Right. There. There. And there. Right. Technically speaking, this high here, for example, right? Technically, this was the highest point that a 4-hour candle did reach. And when price gets there, it's a decent draw on liquidity, right? Price is if we're closer than not to the high of the 4-hour candle, we're probably going to sweep it. But the real important strong draw on liquidity here is going to be this high. And this high here on a 15-minute time frame is more likely to get, let's just say this is our 15-minute time frame, and up here we have again this 4-hour high here or something like that, like just a normal 4-hour high, right? If we have a clean 15-minute gap right there, maybe, and a clean 15-minute high, we don't need this 4-hour high just because it's on a higher time frame, right? It's because of the high isn't made by its time frame, it's made about how obvious it looks in the market, how much liquidity it is responsible for, if that makes sense, right? We'll have a big range and it will be the highest point of the range. And once we sweep that liquidity, that is going to be responsible for a bigger move depending on how big this is. So here, this high is only technically the high of a smaller range within this zone, right? Because we probably came down, came up, and filled that. So now that's the high of this internal move there. Whereas this high is the summary of all of this price action. And once that gets swept, not only once it gets swept will it reverse more, but also if we're close to it, it's more likely to act as a magnet with price. And now what I want to do is I just want to show you guys this live as an example. I'm going to go onto replay mode and I'm going to show you this. One more thing that I'm going to say. Did I click remove drawings now? One more thing that I will say is the way that I enter, which is exactly what I said here. First of all, I'm going to wait, right? Because obviously, regardless of how we trade, we know that the market is going to fill imbalances. So it's going to do what? Held this inefficiency here, or sorry, fair value gap. Held the fair value gap there, right? Traded in, traded higher. Traded in, traded higher. I could probably just long it, right? Like here somewhere. And I know I could have a big stop and whatever, and then maybe it's not going to come all the way down to my shit. But that's bad risk to reward, and that's bad reading of a chart. Because what is price always looking to do? It's either seeking to rebalance inefficiencies or trade into a fair value gap. So it's going to trade into something like this, high, fair value gap, sweep a high, fair value gap. So as I said, it's either looking to take a fair value gap, trade into a fair value gap, or sweep out highs or lows. So here we can see what does price do, and this, I know this is a drawing, but you guys will see when you look back on the chart, this is exactly how it's going to play out. We sweep this high, and this high, right? Then we trade into the fair value gap. Bang. Once we sweep this high, what can I expect us to do again? Trade into the fair value gap that we made. Now, I only take setups as a PD array, meaning premium discount array. I only trade out of 5 and 15-minute fair value gaps. I'm not going to base an entire trading idea based off of a 3-minute fair value gap or a 2-minute, because it's just simply not strong enough of a draw for me. So I'm going to wait until we tap a 5-minute or 15-minute fair value gap, whichever one is there for me. If there's both, I'm going to wait for both. And then after this happens, after we tap this 5-minute or 15-minute fair value gap, the highest time frame inverse on this leg I will take. So let's just say we have a 1-minute fair value gap that gets created on the way down. On the way up, I will enter once we close above that gap on that time frame. If there's a 2-minute fair value gap, I'm waiting for the 2-minute chart to close above the gap. If it's a 3-minute fair value gap, I'm waiting for the 3-minute chart. If it's a 5-minute gap, I'm waiting for the 5-minute chart, etc., etc., right? So that is how I will play it. Why? I can break this down quickly. What are we doing? Taking highs, sweeping highs, taking fair value gaps, sweeping highs, taking fair value gaps. We are going to sweep this high afterwards, right? But before that, what would we just do? Take a fair value gap. Now, when a fair value gap gets hit, right, 2 things can happen. Because we could potentially also leave this high here for much, much later and then do something like this, where we come down, accumulate more, and then sweep it, which obviously I don't want. So what do? I wait not only to see that we're going to get a reaction out of this. So we sweep the gap and we start flipping bullish again, which is exactly what I wanted. From here, we could use this 1 minute or the highest time frame fair value gap in this leg, we would likely, if we were looking to seek lower prices, we would likely trade up, trade higher, sweep this gap, and then use that to go lower and maybe inverse this 5-minute gap, which I'm taking my trade out of. So once not only the 5-minute gets reacted out of, but also it inverses the zone that it would use to take price back lower. It's basically like it has no more juice left inside of it to go lower. It has no more, it's past, the last line of defense has been dribbled past. It's just me and an open goal now, right? Maybe there's a goalkeeper, but he can't do much. And at that point, it's just you and your probabilities. But that alone in itself, just reading the chart like that, sweeping highs, taking fair value gaps. About to sweep this high, didn't take it. That's where the secret rule comes in, that we know how does price work when they edge a level. And this is something that you can't really explain psychologically in the market. It just is something, a phenomenon that occurs and that makes sense. And we don't sweep the level, but it's so obviously going to get swept. So we retrace. Now we're respecting this 5-minute, the same way we did there and the same way we did there. And now, after that, the only way that they could ever go lower is by using this 1 or 2 or 3 minute fair value gap too. And once they fail to use that gap, bang, money's there, money's ours. We're taking that bread from fucking Jerome Powell like it's free cheesecake in a factory, bro. And that's exactly what I want you boys to go and do. I'm going to show you guys exactly how this plays out. For example, yesterday. Here we go. So coming into market open, obviously we're consolidating here. We are bearish at this point, right? We were bullish. We were bearish until we swept this low here, because this for me was my point of reversal where I would expect us to reverse. And after that, we didn't have much movement lower. So we had this, right? We had this London low plus previous day low. So now we have two of those, of the list that I gave you, two of them in one. That's a fucking strong draw on liquidity. So now, what am I going to do? I'm going to wait. I wanted to take a reversal off of this. I actually got stopped out on my first trade, taking a reversal off of this, right? So now, what do? I can just let this play out. We get a 5-minute fair value gap. First trade idea. Can this pause maybe? Bro, come on. Surely it's paused. If we hadn't swept previous day low and London low, and we had more draws on liquidity to the downside, right? We could have waited for price to sweep this gap and then used it to come lower. Because on top of that, what do we also have here? A 15-minute fair value gap, bro. I'm not even going to do all that now. But we have a... What? Bro, why the fuck is she lagging now? My bad, boys. Sorry about that. But you saw that. We have a 15... I'm just going to go back on it now. Here. Clean 15-minute fair value gap right there. This big one. So we have a 5 and a 15. If we had lower draws on liquidity, we could have taken a trade into that, right? But we don't. So now, after we swept it, what are we likely to do? We're likely to buy back into these draws on liquidity up here. We have some strong highs. I'm pretty sure we have a 1-hour fair value gap up here now. Yeah, we do. Clean 1 hour, maybe even a 4 hour, right? But these are good draws on liquidity. We have all of these highs here that are probably going to get raided after sweeping this previous day low and London low, okay? So we're bullish now. We know we're bullish. All we need now is a continuation higher into one of these levels. And now what am I going to do? Let this play out. And in this case, we didn't get the relative equal highs with the key level. But here, you see these highs right there. These highs are for sure going to get swept. Why? Because they're so obvious. You see, they are the New York AM open high. And it's this big consolidation move here's high. And right now, in this leg, we would have probably expected price to come there and then reverse lower if that was what they wanted to do. but they're needing momentum to push it higher. And this is for sure our strong next draw on liquidity. Let's just see, is that lying inside a 1 hour even? Might be, yes. We've got a 1 hour fair value gap right there. That's a strong draw on liquidity. And this zone in itself, we missed it by about 70 points, right? That's not that much movement. And this isn't going to work as well as when it's perfect relative equal highs, because the closer we get to the level, the more confirmation you have. But this is already a good start of showing you guys how to play this. And this is the most recent trading example. So I could probably pull up a few more and I might edit that in. I'm just going to see. I could also try and just go back a few days and see if I can find anything. But the closer you guys get to the level that you're trading into, the more obvious of a trade it's going to be. So the way you can play this now is you can mark out this 5 minute fair value gap here, right? We mark this out. Bang. Go on to the 1 minute chart. I'm pretty sure this entry, I took a 30-second entry. Yeah. There was a 30-second gap and I longed it right there. Right here, I got in there. My stop loss went here. And I didn't even need to target all of these highs, because you'll find often when you're trading into your draw on liquidity, that's also another thing that used to confuse me, that I would really like to clear up for a lot of you guys. When you're trading into a draw on liquidity, right, it doesn't necessarily mean that you need to trade into this draw now and that must be your take profit, right? What it often means is that the momentum that price has going in that direction is going to help deliver your trade to its take profit within that bigger move. So right now, we're completing this market maker buy model probably up to these highs here, okay? So once that happens, price could look to continue bearish again. You don't need to hold up until here, but what that does help you with is tell you, okay, if I'm going to take longs now, I should be good up until here. So let's just say you got a bad risk to reward and your stop was here. No problem, because you know you have these draws here. You don't have to target them, but you can target close to them, knowing that price is going to deliver there with momentum because there's a magnet pulling price to that direction. And yeah, that's exactly how this trade played out. And again, another one closer now to these highs here, right? And again, what do? Wait for us to create a 5 minute. Did we? Sorry, boys. Got a phone call there. That's not good. Give me 2 seconds. I'm gonna call you now. Yeah. Sorry, boys. Fuck, I missed this, but there was one more little setup that we could have caught there in this small 5 minute. But even though that got inversed, we wouldn't really be looking to take a trade out of that, right? But the point is, we had an edge towards those draws down there. Along with higher up, we get an edge towards these draws here, right? And I'm sure if we look onto a smaller time frame again, we can see, oh no, this just straight manipulated there. But here, we didn't get an entry up, but we can see this level here. Once we were so close to, like here, how close is this? Like we are so close to these highs now. We are 40 points away. Once we edged them, pulled back into something, I don't think we would have gotten an entry because there wasn't a 5. Oh, it was. This was the entry. Pulled back into this 5 minute, right? And once it inversed higher, our entry would have been right there, as I explained in the previous examples. Would have entered on this inversion, stops at the low, and could have targeted this draw on liquidity perfectly. And as we can see, the momentum that we displaced with when we were actually reaching this draw is 1, 2, 3. You see this, like 60 points in 4 candles pretty much. And that's exactly what we're trying to use the draws on liquidity for. And once we're so close to this draw, it becomes more and more obvious the closer we get. So if we had stopped here and then retraced far down, even more likely that we're going to come back up, right? And that's just exactly how this plays out, which I wanted to show you boys. And each time, see here, strong draw on liquidity, right there. Beautiful draw on liquidity. Look at that high. Very prominent high right there. Edge the high, pull back into a 5-minute, and then we trade back higher into these highs there. Pull back into a 5-minute, trade back higher into these highs. After not quite edging, I wouldn't call this edging, but definitely pushing towards that high, right? And now I'm assuming we're going to deliver to New York still, because New York AM is right there. There we go. See, bang. Completed the full market maker buy model. And again, if I go onto the 5, let's see if we got another entry higher there. Nope, unfortunately not. But again, that's my entry model. You guys could have seen this. Maybe you enter off of a 3-minute gap tap or a 2-minute gap tap, right? And what happened here? We edged the high. Okay, we never actually got a pullback. We got a retrace into here. So we edged this high here, right there, by about 5 or 10 points. There. Pulled back into this 2. If that's how you trade, and you are just scalping direction, which I don't do, but a lot of people do, I'm sure there's a 30-second inversion in there, and that targets straight back up to this high. And the most important part of this whole rule and lesson that I'm busy teaching you guys isn't the way I use it in terms of my entry model. It's about the fact that you could have used this and reverse engineer your trade around the draw on liquidity, and once we got close to it, taking continuations into it off of whatever you like, right? And up until this point, from down here all the way till up here, you pretty much knew we were going to be bullish, and as soon as you got continuation into a mid or higher time frame draw on liquidity, bang, money. Take that shit straight up. But yeah, boys, I hope that was helpful, and I'm gonna see you guys in the next one. If this somehow didn't, I recorded this video already and it didn't record. If this somehow did not record, I'm low-key just gonna. But much love, boys. I'm gonna check you guys in the next one. Don't forget to subscribe. Check out my Instagram. Check out the gram. Check out the gram. I'm much cooler on Instagram. Trust me. Trust me, daddy.